Hello everyone, welcome to Blue Dragon Actuarial. So today's topic is related to impact of hedging on capital. This question is actually asked to me by someone by messaging me on WhatsApp, and I will request everyone. So if you have a concept related question, there is a process which we will discuss at the end of this video. You can reach out to me through that method and not by messaging through WhatsApp, because I believe that if you are drawing on my experience, then I think that is a service that I'm providing to you, and there should be a proper channel for that. If you have any question related to, as for example, career, right, or you are stuck in a zone, you don't know which paper to appear, that is something that is sort of counseling, and I can do that very normally. But if you have a question related to concept, I believe that that should be a paid session, and you should go into that domain, and there is a structure that we have defined, so that we don't get this sort of question. Otherwise, I was getting too many questions from Profit and GGO Access, and honestly, I don't have the time to kind of do that. So otherwise, I have to refuse someone and kind of help someone else. So I don't want that to be the case. Like, anyways, moving on. So impact of hedging on capital. So first, we have to understand what is the relation between capital and risk. So the entire world has moved from factor-based capital. Factor-based capital means you have some factor like maybe 4% of reserve, or 3% of reserve, or 3% of sum at risk, or 0.3% of sum at risk. That you will multiply with the reserve and sum at risk and arrive at a capital, right? So that is called factor-based capital. And from there, we have moved to risk-based capital. For Solvency II introduces the risk-based capital, and then IFRS 17 kind of adopted that. And this capitals are calculated on economic capital approach. What is economic capital? If that is not clear to you, we are considering course on that, and it will be soon launched, maybe early next year. So we are also bringing the course of the first course, which we are calling Sparkle One, where there will be 8 topic and maybe 1 or 2 bonus topics. So overall, it will be 9 topics. It will be priced below 1,000, and it will try to breach the gap between fresher and experienced people who there is a lot of gap there, and also it is for people who are interested in such kind of removing that gap. There might be people who are just interested in papers, so then that's their mindset, and that course is not for them. But people who are interested in bridging the gap between fresher and what is required in the industry, that course should be for them, and that's why it's priced cheaply. If someone is interested, they should be able to do that. So that is one of the courses. Maybe my marketing partner is looking into that. You'll see some promotions very soon on that. We are calling it Sparkle One, and then in Diwali we'll be launching our first course on actual software, which is GGY Access, and that would not be priced cheaply, because it will be for slightly experienced people, because fresher probably would not understand that, and that will be around Diwali. So that this is our attempt to bridge the gap between fresher and the experienced people in the industry, and no other coaching center can do that, because they themselves don't understand or know this. So that is where we come in, and we can bridge the gap. But also, this is our kind of attempt to understand whether the market really needs that. Right? If we see less of interest in such courses, and more interested in paper based courses, then why should we bring that course, right? Then it should not be like, then there might not be any course on economic capital, because if anyone is not interested in understanding economic capital, why should I bring a course on that? However, if that interest is kind of visible in these two courses, we are just testing the water in that case. So if you are interested in such courses, then those are the two courses that you have to purchase, because otherwise I'll not understand that, right? Anyways, moving on. So lower the risk, lower the capital. That is why it is called risk-based capital, right? Lower the risk, lower the capital. You have to a certain what is your risk, and depending on risk, your capital will be lower, right? So why hedging is needed for an insurer? Because an insurer faces an asymmetric risk, and we'll see later on in this presentation what do I mean by an asymmetric risk. Because of financial options, and also it happens for modality options. Modality option means where you can alter the policy, like maybe you can alter the term of the policy without any underwriting, or you can increase the sum assured, something like that, right? Or you can maybe convert it into a different policy. A financial option means when you are giving some sort of guarantee, As for example, you are giving a guarantee, maybe every fifth year, policyholder can choose a certain percentage of which then would be mandatory for the insurer to provide that guarantee. Say 4%, right? So 4% guarantee. So no matter what happens in the market, whether the market crashes by 40%, like right now, there is a war going on in Israel and Palestine, and anything can happen in the market, right? So even if the market crashes by 30%, the insurer still has to provide 4% return, right? And that is the asymmetry I'm talking about. If it is over 4%, then insurer has no problem. But if it is lower than 4%, no matter how much it falls, the insurer has to provide that 4% return. So that is the financial options, right? And for our financial guarantee and modality options, we have already discussed, right? So hedging can be used to change this asymmetric risk, and that also we see an example, and maybe understand in more detail. And usually hedge is used for financial options, although in modality options also there are some hedge available, though not available in Indian market, but in foreign market, especially in UK market, European market, such sort of things are available. Longevity swaps is one such example. Probably have heard of this, right? So, but in Indian market there is no such sort of swaps. In Indian market, the derivative market is very poor. It's not that, I mean, it's not that deep or liquid. So that's why in Indian market, normal swaps are just difficult to get. Longevity swaps is too high of a task or risk. And modelling options are mostly tackled through underwriting and reinsurance. So instead of going through these derivatives like longevity swaps, so there are other methods as well where you can kind of purchase some derivatives, financial derivatives. But usually these are kind of tackled through underwriting and reinsurance. If your reinsurer is willing to take that an asymmetric risk, or if you're underwriting such that it does not impact you, you are only selecting good health people, or people who are in good health, then you would not be kind of bothered about this. That's why we'll focus on financial options and guarantees when you are talking about hedge. Although hedge can also apply for modality options and guarantees, right? And as I mentioned, in UK market, there is a lot of longevity swaps and etc. All of these things are available, but usually also even for them also they would require a very good underwriting and reinsurance policy so that they can tackle the modality options, right? So moving on, how this arises. If like I mentioned, if an insurer guarantees a return, say 4% or highest NAV guarantee. Now, earlier in Indian market, there was highest NAV guarantee that was kind of given, like whatever the NAV is, highest value of NAV in a particular, in the term of the, maybe say a unit link product, that would be kind of given to the policyholder. But after 2012, uh, kind of IRD kind of removed those products, and there was a regulation passed that no insurer can give such guarantee. In fact, SEBI also has a regulation that you cannot have any sort of competition in India. Like in rest of the world, there is competition held by people wants millions of dollars of cash prize, and then there is a competition on trading. If you want to participate in that competition, you have to show certain degree of return consistency, and then you can participate in that. And if you are at the top, then you get good amount of cash prize. But such sort of guarantee returns, etc., are not allowed in Indian market. SEBI is very prudent. In fact, all our regulators are kind of very, very prudent. And in fact, in one of my brokers, Zerodha, there is something called 60 days challenge, which means that for 60 days you have to be profitable, because that is also very difficult to do in trading. And SEBI actually passed a rule to kind of remove that. That there is no such, you cannot have such thing that you have to be profitable. You cannot give such guarantee. You cannot say that you will provide a service of 20% guarantee. So it is a joint kind of effort by the regulator, and that's why this sort of products are removed. But this sort of product is very, very prevalent in US market. As for example, in US market, there is something called universal life product, which is kind of an Indian equivalent of whole life product. And you can have this sort of guarantee here, or variable universal life product, or variable annuities product. So in US market, Canadian market is a very, very common things, and you can have those guarantees. But in Indian market, these products are not there anymore. This means if the market actually stays over 4% level, there is no issue for the insured, right? This is the asymmetry portion of the risk. But if it falls below that level, then the guarantee bites. This is also known as guarantee has moved in the money, right? So earlier the guarantee was out of money, and now the guarantee has moved in the money. When the guarantee bites, it is called in the money. So insurance is a seller of put option, because when you buy put option, you want the market to go down, because that will be beneficial for you. But when you are seller of put option, you want the market to stay at a certain level, right? It should not fall below a certain level. It should be above that level, or even if it comes down, it should not come down below that level. If it so that's why insurer in such sort of guarantee, 4% guarantee, insurer is a seller of put option, right? So just to give an example, this is kind of a nifty chart, and if you see this, this is the loss area for the insurance. This is that orange area is the loss making area. You can also see in the max loss it is defined as undefined, but the max profit is only around 47 lakhs. So this means that insurer can only make 47 lakhs or 47.55 lakhs. However, the loss can be unlimited, right? So this is an example of asymmetric risk, that your profit can be limited, only restricted. You cannot make more profit than this. But if you're losing it, it can be unlimited, right? So this unlimited thing is the asymmetry portion of this. And when you are selling an option, you want this is your break even level. That's 20,005. That is kind of written. You don't want the market to fall below that 20,005 level, right? Same is the case with when an insurer is providing 4% guarantee. You don't want the market to fall below that level, that 4% level, because if it falls, then there's no matter how much it falls, right? That would be the risk for the insurer, right? So the more it falls, the more riskier it is for the insurer. That's why insurer is a seller of put option, right? So insurer behaves as a seller of put option when they provide this sort of financial guarantee. I hope this is clear. For this diagram, it should be very, very clear, right? So that's why trading, actually everything is kind of related, right? I was having a discussion with one person who's a fresher, and I these days I get very, I see people who have such rigid mindset, and that person was telling me that actually is different and trading is completely different, and that is not the case, right? Here you can see there is a clear link between how an insurer is facing an asymmetric risk, and in trading also you face the same risk. The reason I'm good in trading is because I understand actually, because I can relate my theoretical concept with the practical one. So otherwise, there is no point in understanding actually if you can't apply all those knowledge, right? Anyways, moving on. So this is an example of asymmetric risk. So how it can hedge? Obviously, it can buy a put option because it is a seller of put option. So if it buys a put option at some distance, right, then insurer will lose something, but then that risk would be capped, right? And we'll see an example of that. The insurer will protect against this will protect the insurer against the downside risk. The risk became capped, right, and is no longer an asymmetric risk. So this is an example. So here in the earlier example, they were selling this. This negative means selling, right? Negative sign, that means selling. So they were selling, and the loss, the profit that the insurer was making was around 47.55 lakhs. But in this case, the insurer has bought some put option, and in that way, the maximum loss is kind of 16 lakhs, right? Although the insurer is making less profit than the loss the insurer can make, but in this case, the asymmetry is removed, right? In this case, the loss is kind of capped, right? So, and how the insurer has kind of come up with this strategy to cap the loss, the insurer sacrificed the profit. So instead of getting 47.55 lakhs, which the insurer was earlier making, the insurer has reduced the profit to 8.22 lakhs. And because the insurer has sacrificed that profit potential, the insurer was also able to cap the loss, right? And there can be several strategies, like I can do multiple strategies so that instead of 8.2, this became maybe 32, or this became 4, right? There are so many strategies, but for this is not a presentation on trading, this is a presentation on hedging. So that's why you don't need to understand that. What you need to understand is by buying option, right, the insurer is capping the asymmetry portion, and its risk is now limited. Now also, even in this condition also, the insurer can make loss, but now the loss is limited, the loss is restricted, right? So that's how the insurer is kind of if the insurer buy put option, the loss is restricted, and that's how the asymmetry is kind of converted. This is now converted to maybe a sort of a symmetric risk, or sort of the unlimited risk is now limited, right? So something like that. Moving on, cost of hedging. Obviously, there is no free lunch, right? And hedging has a cost, and it comes out of your free capital. Right? So whatever capital you have free, you have to kind of pay or use that capital to pay for the option premium, right? Because when you are buying an option, you have to pay a premium for it. However, this also reduces the risk and hence reduces the solvency capital. So it frees up more capital, right? Because as I mentioned, we have moved into risk-based capital because of hedging from maybe from an unasymmetric risk or from an asymmetric, maybe from not so asymmetric risk, we have moved into a limited risk, right? And because of that movement, the risk has actually reduced, like we have seen from unlimited risk, we have moved to 16 point something, 16 point something lakhs of risk. And because of that reduction of risk, the solvency capital reduced because it's based on solvency or economic capital approach or risk-based capital approach. So your free capital also increases in that way, right? But also there is a hedging as a cost, so free capital also reduces. Now it is the interplay between those factors, and usually this will increase the free capital. The cost of hedging would not be so much as compared to the capital it will free up, right? So this is the first relation between hedging and capital, because if you are doing hedging, then you are kind of freeing up capital. In fact, in IFRS 17 there is a portion called mitigation, risk mitigation, and which deals with this, and that is for BFA sort of product, which product, those products that are linked with the market. Now, as I mentioned, for Indian market, these products are not that relevant. Indian market, you cannot give such guarantee. It is prohibited by SEBI regulation and IRT regulation jointly, both, right? Both prohibits this. But in US market, in the Canadian market, these products are very, very common, extremely common, right? Because those market are not moving up that much as compared to an Indian market, which is more volatile. Indian market is very narrative driven. It moves on whatever story someone tells, right? But those markets in US and Canada, they are more mature and they interpret the story far more better than the Indian market does, and that's why there is this sort of guarantee is very, very important there, and people can probably deal with this guarantee in much better way as compared to Indian market. So that's it. Moving on. So the most common hedging for the insurer, especially I'm talking about life insurance, right? So there is a reinvestment risk, especially for long-term contract, because you are getting the premium and that premium would be invested. Sometimes you are not getting the entire premium in a single premium contract. You might get the entire premium, but in the regular premium contract, you might get a portion of the premium, and then the remaining portion would come at later date, which you have to invest at some different terms and conditions. The bond might have rate might have changed depending on quantitative easing or quantitative tightening, etc., etc. Many things can happen, right? Or some situation like this one, there is a war going on, things might change. So because of that, there is a huge amount of reinvestment risk. You don't know what terms would be available maybe 5 years down the line, right? Even for a single premium product, if the bond that you are investing in is only available for say 10 years, and the contract duration or the policy duration is for maybe 20 years, then after 10 years you have to invest the coupon and the maturity amount, the redemption amount, etc., right? And in that case also there will be reinvestment risk. So the most common sort of hedging that is kind of done by the insurer, which is also part of Indian ALSM regulation, asset liability solvency management regulation, that is to protect against the the downside risk of the interest rate falling down basically, and that is for without profit contract. For with profit contract, you can play with that, right? You can reduce the bonus and everything, but for non-profit contract or where the profits are not shared, you are allowed to hedge, and usually the hedging instrument is interest rate swap. There is another instrument called forward rate agreements. Right? So there can also be exchange traded futures. There are so many instruments, but usually the most preferred is interest rate swap. Now, I don't want to go into detail of what is interest rate swap. I hope that you understand what is interest rate swap, that it swaps the floating rate with the fixed rate, right? So I hope that you understand that. And if you don't understand that, you can write in the comment section. I can make a separate video on that. But I believe that as an actual student, you probably already know that, right? And you can also Google. So there will be an intermediary, like there will be a party, third party, who will be kind of bringing two parties who are looking for interest rate swaps, and usually these are kind of catered to the needs of those two parties. That's why these are over the counter product. Like this is not a standard product, so it does not trade over an exchange, right? Especially in India, these are all over the counter product, right? So for safety, you need to post collateral, because otherwise there is no guarantee that when the situation turns green for one counterparty, the other counterparty will, that counterparty may not pay, right? So you have to post some collateral, and there will be some convention like ISDN convention, depending on who is the collateral based. ISDN is International Security of Derivatives Association, something like that, and they have a proper collateral mechanism. They determine your margin, and there are several. Once again, I'll be going into the hedging part of it or trading part of it, right? Which is a different thing. But you can understand there should be like maybe one counterparty is asked to deposit $1,000. Another counterparty is maybe asked to deposit $1,500, depending on their assessment of the risk of this bank, right? And they have to maintain that collateral. So if their collateral falls below that particular value, then they once again have to keep up with the collateral, right? They have to increase the collateral so that the collateral comes to that pre-decided limit. And because of that fluctuation, the free capital may increase or may decrease. So if it goes in your favor, the free capital might increase, right? Or the collateral value might increase. You can also take out that free portion from the, because that is over the limit, right? So you can add it to your free capital. Here it has gone in your favor, right? But if it falls or if it goes against you, then you probably have to take some portion from the free capital and put it into the collateral, right? So this is also better known as mark to market settlement. Like however the market moves, you have to kind of play along with that. And this is usually very, very popular in futures, right? So if you have traded futures, you already know that whatever, if you are in a loss situation, maybe you have not realized that loss, but from your account, that portion will be deducted, right? And then when you are in a profitable situation, if you are seeing maybe 5,000 rupees profit, then in your capital, that 5,000 will be added, although you may not have realized the profit at that point of time, right? So in this way, mark to market settlement occurs in futures, and that also occurs in swaps, right? The OTC. So coming to the final conclusion, so there is no clear answer for this one. As you can see, the free capital is fluctuating when you are doing the maybe the interest rate swaps, right? And however, hedging reduces solvency capital. That is a given because you are reducing risk. So the solvency capital reduces. The free capital is automatically then going to increase because the solvency capital reduces. But once again, some amount of free capital has to be given for the cost or to bear the cost of the hedging, right? But free capital may keep on fluctuating depending on the market condition. We already have seen that. In case of option buying, there is no such fluctuation because in option buying, that is the maximum amount you can lose, right? So in that 4% guarantee example, if you are purchasing a put option, then that is what then that is the maximum thing that you can lose, the option premium, right? So that is why it is called an option. So there is no mark to market settlement here. So because of that, if you have purchased the maybe the call option, put option for maybe 1,000 rupees, right? So then that 1,000 rupees is the maximum that you can lose, and in that case, there is no free capital fluctuation. However, if you are purchasing maybe a forward rate agreements or exchange traded futures or interest rate swaps, depending on how you are kind of protecting yourself against the fall in the decline in the interest rate, right? That is the main sort of hedging that a life insurance does, right? Instead of, because 4% guarantee or the any highest dynamic guarantee, that is not applicable for Indian market, but for Indian market, which is applicable is this: how you can protect yourself from the downside risk with respect to interest rate, and that for that you have to, usually the method is swaps, like I mentioned. And if you are kind of doing maybe going into an interest rate swap where you are swapping the floating rate with the free fixed rate, then obviously there will be collateral that you have to post with the third party, and depending on the mark to market settlement there, your free capital will fluctuate, right? So there is no final conclusion on this one, but obviously the free capital will change, right? And that's how, depending on that, your free capital, but obviously that change in capital would not be that much until unless there is some crash in the market, right? Otherwise, it would be a very nominal thing for you, and you probably would have some amount of working capital so that you can deal with such situation. That would be the cost of hedging once again in this case as well. Because when you enter into swap, there is nothing that you are paying, right? Or when you are entering into maybe a forward, there is nothing that you are paying, but some amount of your margin is blocked as a collateral, right? So that is the cost of hedging when you are kind of entering into such contracts, right? So like I mentioned, if you are a fresher, especially I've seen for the fresher, there are so many questions, and instead of asking those questions directly to me, I would suggest first to do some homework. And for that homework, you should go into our site, which is bluedragonuniverse.in, and you can see In a one section, there would be introduction to Actuary, which is a free course. You can enroll there. There are, I think, 4 hours of video content there. It should answer all questions that you have. If you still have questions, there are a few FAQs that we have conducted. There are, I think, 9 or 10 questions, and depending on investment, and maybe life insurance or other alternate fields, all of those questions are kind of covered here. And even after that, like I mentioned, if you have some questions, something like this, right, a normal technical question, right, then you should connect with me by purchasing this, and our team will reach out to you and then ask what question you have. And once you share the question, we'll fix the time so that you can understand that process, right? Otherwise, if you directly WhatsApp me a question like a technical question like this, I'll just have to say that, hey, you want to go and maybe you have to purchase that course, because otherwise I can't keep on answering these questions for everyone, right? Because it is very difficult for me. I won't have the time for that. Then I'll be answering questions for few people, and I'll not be able to answer questions for few more people, right? So that is where I would like to kind of promote this, and also you are drawing on my service so or experience, right? So I believe this is a fair play, and this is only charged at 500. So if you have some questions, you can use this method until unless you have some career related question. For that, I don't think there is no need for you to pay. So you can directly reach out to me, and I can help you with that question. This is only required for technical question, or if you feel that no, I want undivided attention and I want to discuss something with Arpan for 60 minutes, then this is the method for you. So I think that's it. I hope you have enjoyed the video and content. You have understood what I said. If you have any confusion, you can write that in the comment section. I can try to answer. Next week, I've already posted on LinkedIn about a question. What would happen if in the Black-Scholes related something related to Black-Scholes formula, and once again we'll see that next week, right? So if you want to take a shot at that question, you can do that. Saurabh Khaitan has already taken a very good shot at that question. And I think probably 90% of that answer has been already been given by him. So you can also check his answer. You can, if you have a difference or counter opinion, you can share that, right? Don't try to complicate answer like someone in my WhatsApp group gave an answer and he or she complicated it completely, right? And at one point of time, I was seeing the answer and I was not understanding anything that he was trying to say. It's just complication. So you have to stay. If you want to be a good actuary, you cannot complicate answer. You have to simplify it for others. If you are complicating it, which is already complicated, like actually is already a complicated subject, then what good it does or what value it brings for others, right? So you will not get the desired thing if you complicated stuff, right? So you will only get whatever you need from actually if you can simplify those stuff. So try to break a complex problem into maybe several small problems and try to come up with the answer. Like here, I have tried to kind of do that, right? So I hope you understand that point. Thanks for watching this video. Please share this video with your friends. Share the name of my channel with your friends. This is where we share counseling videos as well as knowledge session videos like this. See you in future videos.